Okay, we're going to go ahead and kick off our webinar series today. Thank you all for joining us. We have a great session today. For those of you who don't know me, my name is Brett Bernstein. I'm the co-founder and CEO of XML Financial Group. We are an independent wealth management firm that oversees client assets of nearly $4 billion. And we help individuals, couples, small to medium-sized businesses, and nonprofit organizations with their financial planning, wealth management, and insurance needs. Little housekeeping, there is a Q&A section. If you go ahead and click that throughout the presentation with any questions that you have, we'll do our best to get to those either throughout the presentation or in the end. And let's go ahead and kick this off. I'm very fortunate to have Suzette LaBonne with us from Goldman Sachs Select. I've known Suzette for probably the better part of my entire career, and we work with her exclusively on securities-based lending. And so I'm going to turn it over to Suzette to kick it off, give a little bit of her background, and really start to explain what is securities-based lending.
Thank you, Brad, and thanks for having me today. By way of background, I am a 30-plus year banker focused historically on middle market lending and high net worth clients and their financing needs. I joined Goldman roughly 10 years ago when we launched Goldman Sachs Select as a liquidity tool for clients. Select is not a direct-to-client business. We only work with wealth management firms such as XML to partner together to provide liquidity solutions for clients. So I guess let's jump into what is a securities-based line of credit. I would say it is a tool to provide liquidity for short-term borrowing needs. So it's a pledging of an account with securities in it as an alternative to liquidating an account for a borrowing need. So it is revolving in nature. A client can borrow, repay, and borrow again. It allows really a mechanism for borrowing against securities, including equities, mutual funds, ETFs, bonds, treasuries, cash, really an entire account that's diversified in most cases. It is interest only, so there's no principal payment. Client can make as little as an interest payment each month and pay back at any time without any prepayment penalties. Interest rates are tied to term SOFR as our index. SOFR stands for Secured Overnight Funding Rate, and it's the typical instrument today used in the marketplace as an index for lending. Many people are more familiar with Prime as an index, or perhaps even LIBOR. LIBOR was sunset back in 21 and replaced with SOFR, so it's the more common index that's seen in the market. I would say that Prime is more of a synthetic rate, not really tied to market, and it's more of a consumer rate that we see in things like home equity lines, and we can touch base on that in a little bit. Typically, clients can borrow anywhere from 50 up to 95% of the overall value of an account. And the difference between those sort of parameters is what's the asset mix in the account. If it's more equity focused, mutual funds and ETFs, they're going to be borrowing at about 50% of the value of the account. But if there's a mixture of some bonds and cash, et cetera, then you're going to see that release rate going a little bit higher.
So let's break down for a minute. I think some things that, I know how we've used it with clients and how, I know clients might be thinking about it. So I think it's important, I like to give analogies, right? It's kind of like a home equity line, right? Except instead of using your home as collateral, you're using taxable accounts. And it's very important, right? You cannot use retirement accounts. This is for taxable accounts. And I think, as Suzette pointed out, kind of the rule of thumb when we work with clients is to think roughly 50%. And again, the more concentrated the position of the security you have, right, the less someone might be willing to lend versus the more diversified portfolio that you may have. And, I think it's key, Suzette, what you pointed out is short-term lending. This is not meant to replace a 30-year mortgage. And I think throughout our conversation today, we're going to give some examples, and I'll use one that comes up. Real estate is probably one of the biggest. I know, Suzette, I talk about this all the time, and I think almost not exclusively, but a lot of what I see with the clients I work with. We have many clients who are looking at continuing care retirement communities, which might require significant down payments, right? And then they might be selling their primary residence. Well, how do you get that access, right? Do you get a home equity line? Do you liquidate your portfolio? Are there tax consequences being in and out of the markets? And so this really allows us as an advisor in doing the full financial planning with our client to really take a step back and look strategically at the portfolio, the markets, geopolitically, what's going on, the short-term needs you have, and do people want to potentially get hammered with taxes? I mean, what do you see besides that, other of uses of how people use securities-based lending?
Yeah, I do think the key point there is short term, right? So stepping out of the market and the implications of that for something that most clients know the duration of the borrowing need. So to your point, I would say bridging real estate is our number one use case. Client purchasing a retirement home before they sell the primary. We know the market on the real estate side continues to be very strong. And so most clients are looking to make an all-cash offer to make themselves more attractive. So they'll use the line as a mechanism to bid and purchase the house and then repay with the proceeds of the sale of their primary home. Again, I think that the timing of getting in and out of the market, as we know, can be very strategic, and incurring capital gains for short-term borrowing needs just makes no sense. So really the relationship between GS Select and XML is to provide a tool to manage both sides of the balance sheet, right? Making sure you're keeping the assets long in the market, keeping that financial plan in place while addressing some short-term borrowing needs with a line. Typically, rates on our lines are very competitive in the marketplace relative to some options out there as well. So there's no fees to put the line in place. The only cost associated with our lines of credit is interest expense on whatever portion of the line the client is using. And then they can pay it back at any time without any prepayment. So that cash flow flexibility of interest only without any cost embedded makes this a really attractive vehicle for that number one use case of bridging real estate. I would say that's closely followed by real estate investors who are repositioning real estate and will again have a short-term flip on that transaction. And so they keep their investments long in the market, but they have a line of credit to get themselves liquidity for that transaction.
Yeah, I think one that I see typically is, a client came to me and wanted to purchase a new home, and they needed to go in strong with a cash offer. They came to me saying, why don't we liquidate $1 million of securities as their planner? I didn't think that made sense for all the reasons you talked about, right? Taxes not being allocated in the market. And I think with what we're seeing in the markets today, I mean, look at how quickly they are moving up and down with the news, right, that's going on throughout the world. And so in this particular client's case, they were able to borrow, and in their case, they used multiple accounts to get to the $1 million they needed. And I know we'll talk about that in a little bit. So they were able to use multiple accounts. A question popped up, can you use private trusts? And I know it depends on the language of the trust, but yes, if it is a taxable account, typically, if the trust language allows for it, you can. And that's something that Suzette and her team would look through and ensure that it is permissible to be able to do. But in this case, the client was able to go in with a cash offer on their home. They were able to settle. The home they were selling took a little bit longer than they were hoping, but about 4 months later, they sold their previous home and they were able to pay off the line of credit. And so what's great is it only costs them the interest for roughly the 4 months. And you're only, like a home equity line, you're only paying interest on what you borrow. So in their case, they put a $50,000 down payment down. They only paid interest on the 50,000. But then when they settled and put the 950,000 down, now they started paying interest on that. And then when they pay it off or down, obviously the interest payment goes down accordingly. So that's a typical example that we see. I should point out, different clients on here. We at XML use two different custodians. One is Fidelity, and on our Fidelity platform, we work with Goldman Sachs, and we have the ability to pick whoever we think is the best out there. And Goldman and Suzette's team have been amazing. We also have clients who are on our first clearing platform through Wells Fargo, and Wells Fargo has their own lending platform and they set their rates separately. So I think it's important for those of you on here and when you do connect with your wealth advisor at XML with questions, depending on which platform you're on, they'll be able to address those questions. So I just wanted to make sure I mentioned that.
So I'm going to add a couple points to what you outlined there. So I think the ability to pledge multiple registrations for one line is powerful. So to your point, you could pledge in an example your individual account, your joint account with whomever, and your trust account for one line of credit, right? So, and that's important because the interest rate on these loans is based on the size of the line that we put in place, not how much the client borrows. So a larger line typically will get you a better rate. And so the aggregation of accounts can help you achieve that. And we work with your advisors at XML to sort of run different scenarios to see what's the best outcome for the client in terms of rate and how to achieve that. I would say that our minimum line amount is $100,000. So the important distinction there is while our minimum line is $100,000, clients can borrow as little as $2,500 on a line once it's established. So we just need enough assets to get to that initial $100,000 line, and then clients can borrow as little as $2,500, which makes it really approachable when you think about it. For let's use an example of a client that has sort of lumpy cash flows, right? They're relying on year-end bonus funds, but they've got tuition obligations during the year. They can use the line to smooth out that cash flow. Again, we know sort of what's the event that pays it down is the bonus dollars that come in. But at that $2,500 minimum, I would say, and $100,000 line, it makes it very approachable for most clients.
Well, I think it's a really good point. And I think, I hear this a lot from clients. They say, well, this seems too good to be true. And it really is an amazing platform, but there are negatives, right? And I think it's important that we touch on those a little bit, and I'll let you dive in deeper. But one of the things is it's really important. This is where your advisor really adds the value to this, is we want to make sure that when you pledge an account, that you don't maximize the borrowing in a volatile market. Because if let's just hypothetically say you pledge $1 million, right? That's the size of the account, and Goldman determines that you could borrow up to 500,000, right? We're using 50%, and you take the full $500,000 right away and look at the markets we've had over the past couple months. If you dip below that, there's something called a margin call, basically, where Goldman will come to the advisor and say, hey, you need to bring that back up to the right amount, or we have the legal right to start selling securities to protect our loan. So it is really important that Suzette's team, our team, and the client work together to make sure that the client doesn't leverage themselves too much to put themselves in a negative position. And that's not negative about the platform. It's an important piece about securities-based lending, lines of credit, is to understand where are the potential negative aspects so that we can alleviate those as much as possible. And Suzette, I don't know if you have things you want to add to that.
Yeah, no, I think that's perfect. I guess I'll put it a little bit in perspective here. So in your example where we're lending 50% against the account, we do create a buffer, right? So a margin call on that account would be at 70%, right? So when we put a line in place, even if the client fully borrowed on the line, we don't put them at the edge of the diving board, right? We create a buffer there for them. That being said, I agree with you 100%. We're conservative in nature, and I think creating additional buffers and accounts are important. The last sort of parameter I'd share with you is the average utilization rate in the industry, as well as at Goldman in our portfolio, is about 30% on our lines. So clients are utilizing about 30% of their lines. That doesn't mean that they don't have a high point, right, around that transaction we've described, right, bridging the real estate. But typically clients are at the top of the line for 3, 4, 5 months, and they know going in, what's my trigger for repayment, right? So I think all of that goes into why we work solely with strong firms like XML to make sure that we're managing both sides of the balance sheet and we fully understand the transaction and don't put
You made a
clients at
good
risk.
point with the term conservative. I've seen, and again, I'm not going to use names, other competitors in the industry, and the way that they lend, the amount that they will go up to, um, it's concerning, right? I mean, it's concerning in volatile markets, and that's where if the advisor isn't knowledgeable, if the client doesn't fully understand it, is when, people can get themselves in a tough situation. We, as example at our firm, all lines of credit come through me. The advisor works with their client. They work with our custodian, but we still want someone else in the firm just to double check because, again, we don't want to put the client, the firm, or anyone in a precarious situation. So I love that you mentioned the word conservative because I think that's very important when looking at lending. And again, this is not for everyone, but I will tell you that, in my 28 plus years in doing this, I am seeing more and more people utilize strategies like this. I mentioned, continuing care retirement facilities. Other things we see is gifting, helping their children, adult children, with down payments for homes and things where the parent may not want to just sell investments and trigger taxes and be out of the market, or maybe they're in gifting, situations that they're dealing with. So, we're seeing, I don't want to use the term older clients, but we are seeing clients that as they are going up in the chain of age and in their life, these needs are starting to become real. It's not just some young client who's trying to be aggressive. No, it's really saying, what do wealthy clients do? They tend to use debt, right? But smart debt, right? And so I think that's really important. And one thing I'll point out, because we've had clients with lines, and if you think back a couple years, right, we obviously have had a crazy 6 years, right? The pandemic started. You had beginning of 2020 when the world was closing, the markets were down 50%. And then who would have thought that the markets would have ended 20 and 21 in double-digit returns? But then all that gain was given back in 2022. But in 2022, not only did you have the portfolios start to go down, you had interest rates start to creep up. So clients start asking questions like, should I pay the loan off? Right? So now what they're saying is, should I take my money out of the market when it just went down? Right? Investing 101 says buy low, sell high, right? But the brain starts saying sell low. And that's where the advisor steps in and really encouraging the client. Hey, even though the rate may have started to go up because they are variable, right? As Suzette mentioned on the Goldman, right? It's a spread tied to SOFR. It starts to go up. But the question is, if I said to you, you could make, these are made up numbers, 6% on your money and pay 4% on the interest, right? You still made 2%. But what if it was the other way around? What if the rate was 6% on the loan and you only made 4% on the portfolio, right? You might say, oh my gosh, I'm losing 2%. The flip side of that is your cost of borrowing was only 2%, right? So we have to look at it and work in a partnership with the client to really say, when is the right time to pay a loan down, to pay it off, to leverage the loan for needs that you have. And again, I just thought it'd be important to try to share some of these examples that I see day in and day out with clients as we talk about this.
Yeah, I think that's in general, a securities-based line of credit is fairly simplistic, right? And it's, you have an account, you want to get liquidity, we put a line in place. I think working with the advisor, it can become much more sophisticated, and it's sort of what you're talking about. And we sort of coin it this wealth transfer strategy, right? And we see it very often in the market where clients retired have worked very diligently with their advisor to put a financial plan in place and estate planning, but they want to get money to their adult child to purchase a first home, right? So it's a very emotional transaction, and so to your point, they could liquidate an account, lose sort of the step up through probate of maybe some low cost basis stock, lose the income, dividends, and interest that they're generating off that portfolio, right? Or we could put a line in place where we pledge mom and dad's account and make the borrower the adult child. So that keeps intact the income for mom and dad off the dividends and interest off the portfolio, and maintains that potential step up, through the probate and when they pass, right, on the inheritance piece. So that's smart planning. And it's a way to really solve for that next gen relationship where they want to get money, but they don't want to disrupt all of that. So I think through thoughtful conversations and planning that your team does so well, we uncover these strategies of how to help clients.
Few questions popped in. The first question was, could you pay off the loan over time? And the answer is absolutely. If you sell a home, for example, and you get that $1 million, you don't have to pay the line off. It's not tied to the sale of your home. It's tied to the securities that you pledge. And there are instances where clients pay down to a certain point. They may choose to add pay it over time monthly. So the answer is yes, you are in total control. And that's what I say. You're in control of when you draw, when you pay it down. I think that's really important. Second question that came up was about private equity and things like that. So not only is it taxable accounts, but it needs to be marketable securities that have what's called a CUSIP, right? So think of it in simple terms: stock, bond, mutual fund, cash, treasuries, exchange fund. Even if it's a concentrated stock, that's okay. Now, when you start getting into things like penny stocks and things like that, that's where Suzette and her team have to really dive in and see if it fits their risk profile. But if you're looking at a private equity investment, right? I invested in a restaurant. No, that is not a marketable security, even if you own it in taxable accounts.
We didn't touch on one thing. So when you talk about private restaurant, I want to say this is a non-purpose loan, right? And what that means, like from a legal perspective, is the only thing that you can't use this line for is to purchase additional marketable securities. If that's what you want to do, then margin is your sort of vehicle to do that, right? In every other case, a line of credit is going to be a better vehicle for you to be able to get liquidity off of the account. I would say that many clients borrow to fund business. So you prompted me with the restaurant, right? Yep. So they borrow to fund an equity transaction where they're launching a new business, right? Or they're putting their children up in a new business, right? So these are all viable borrowing scenarios. Just the proceeds cannot be used to purchase additional marketable securities.
Great point. I think it's important to also mention a few things, little tidbits that come up. The interest that you pay, right, for the borrowing is not deductible. I'm not playing CPA or accountant here, but I can tell you it's non-deductible interest. It's just an important piece to understand. As Suzette mentioned, there's no account fees, there's no holding period, there's no closing fees. What's also great about this is it's a very quick, soft credit. This is not like you're getting a loan on a home. They're not asking for tax returns and your K-1s. It's a very simple. They just want to make sure that you're a good person. They're very quick. And this is what I think where Goldman shines versus many in the industry is, the technology that's behind it, the speed at which an application can be taken, the security of how you verify who you are, how quickly they can turn around the approval process to get you money. It's not going to be overnight, but I can tell you in a handful of days, give or take the situation, it is a very, very quick approach to have. And so when I hear clients say to me, hey, we're going to start looking at homes on the weekend, the first thing I say is, let's talk about what a line is. If a securities-based loan makes sense, let's get the loan in play. So if you need to make that offer Sunday with your realtor, you can go in with a cash offer, not, having now to go to Suzette. Her team has to go through the process. And as quick as they are, it still takes a little bit of time. So again, these are the type of things that we as advisors try to hear from you, the clients. We don't expect the client to say to us, hey, I need a securities-based line of credit. No, our job is to listen to your needs, educate you on the different solutions, and then find the best one for you. I did just see a question pop up here. How often is the rate adjusted once you make a draw? Is it based on the date of the draw, or does it fluctuate daily with SOFR?
Yeah. So we set the rate at 30-day increments based on the anniversary date of the date that we established the line for you. So if it's the 15th of the month, every 15th of the month going there forward, the rate will adjust based on where the index term SOFR is on that date, up or down. So term SOFR is currently, just to give a reference point, as an index, term SOFR is 3.65 today. And just, my smallest line at $100,000 is priced at term SOFR plus 3. So all in today on a $100,000 line, to give sort of a reference point, a client would be paying 6.65%. Prime's at 6.75. So as the line amount goes up, the spread comes down over term SOFR. So again, very competitively priced. And people think about like home equities. We can jump into that just briefly. Home equities require full underwriting, to Brett's point, all of your financial information, your bank statements, et cetera. It's a process. There's cost involved in that. And there's little nuances that are important to clients, such as we don't report to credit agencies. So a client's not going to get debt serviced on our line, where they will on like a home equity. People say to me, well, home equities are deductible. Well, kind of not really, unless you're using it to improve the primary home that the home equity's on. So we help navigate through all of those sort of what's the best use case, right? Based on what the client's looking to borrow for.
The question that popped up, and I think you touched on it, does the line of credit impact your credit score? And the answer is no, because of the soft credit and the way that it's done. We could continue this for a long period of time, but I want to be respectful that we wanted to keep this, right at around 30 minutes. First, let me thank you, Suzette. I know how busy you are with the
pleasure.
amount of people that are borrowing against their portfolio. But I really want to thank all of you who attended. We try to do series on very different topics, right? Not just the market or what, is going on with those types of things, but to bring different educational pieces to you. And what I encourage you to do is, if you want to learn more about this or have questions, reach out to your, XML Wealth advisor. We'll be happy to look at your plan. We'd be happy to update your plan. We'd be happy to see if this fits for you, or if you have friends or family or colleagues that you think this might be of something they want to learn about. We want to be able to help them with that. Thank you all for attending. Please be on the lookout. The recording of this will be posted on our website, and keep an eye out for our newsletter and our website for future workshops that we will be hosting about every 4 to 6 weeks. So thank you again for attending, and we look forward to seeing you at our next one. Thanks again, Suzette.
Thank you.